He's talking about the ECB here, Max, and welcome to the program. I mean, it does seem as though you put up rates, but on the other hand, you're lending out a whole lot of support to people who are facing huge electricity and energy bills looking into the winter. It seems like that in itself is going to act like an interest rate hike. So how do you factor all that in?
Yeah, well, for the dollar, I still think the energy crisis does kind of weigh in favor of a weaker euro versus the dollar. And I think that a lot of the reason that we saw euro-dollar rise back above parity this week was not only the ECB hawkishness, but also the fact that the European Union had basically stored 80% of its gas energy needs for the winter. So that's a good short-term relief. But I don't think this kind of geopolitical tension with the Nord Stream pipeline is going to end anytime soon. So this kind of uncertainty over Europeans' energy security over time is still going to weigh on the euro from a trade balance perspective, and also weigh on the ECB in terms of what it can do. So as Kathleen did point out, the ECB's choices are tougher, and that gives more room for the Fed to be more hawkish than the ECB, which still points to a weaker euro against the dollar.
There seems to be this term now that's been circling, a growth recession in the U.S. Do you think Jay Powell basically has shifted towards that now, and instead of a soft landing scenario, and what does that mean for dollar?
Yeah, I mean, I think the term growth recession is kind of just a new play on the old theme of stagflation, right? And I think the 70s and the 80s template that Powell and some of the central bankers have been mentioning is a good one, that you really can't cut rates anytime soon. So even though you could see a technical recession in the U.S., we know that the last Q2 GDP print was slightly negative. I feel like for most Americans, it's not really going to feel like a recession when prices are still high, when inflation is high, and when the labor market's still quite strong. So I feel like that still gives the Fed a lot of room to continue being hawkish. And I think that it's taken some time, but the market's slowly coming around to the fact that what Powell and what Mester are saying is probably true, that there's no real reason to cut rates in 2023 when you have a tight labor market and when you have inflation still running, at 7-8%.
Max, things are quite funny right now in a sense that it's fairly clear what the Fed wants to do, and everyone tells us it's the strong dollar story and nothing else. Is it easy doing what you do right now? Where's the nuance? Where's the expertise coming in? What are the assumptions that you're making right now moving forward?
Yeah, I mean, I would say it's easy in that the narrative has been around for some time that, we're going to see a stronger dollar on Fed hawkishness relative to other central banks. But where I'd say it's difficult is that the market is always kind of, looking for this pivot. And it's a kind of our job to kind of stick to the long term, the fundamental view, where you're kind of saying, even though you think that, weaker S&P and how it's hitting U.S. ISM, how it's hitting U.S. PMI, maybe that'll cause the Fed to back off. If we look at what the market is saying versus what the Fed is saying, we're clearly going to side with the Fed. So I think the difficulty in my job is trying to convince my colleagues that sometimes the market is wrong. When everyone is so used to this low inflation environment, I think that's where it's tricky. But from a fundamental story, it's quite easy.
Dollar yen, I mean, I wonder, is the dollar going to move just purely on interest rate differentials, Max, or do I look at the risk sentiment and maybe these recession risks that are building, which could actually move dollar yen a bit lower? What's your take on dollar yen now?
I feel like for dollar yen, it's not just an interest rate differential story. It's also a trade deficit story, what's going on in Japan. And high energy prices are still kind of, making these very negative trade deficits in Japan, particularly in yen terms, which is kind of eroding the current account. So I do think that there's always this knee-jerk reaction to dollar yen going lower on risk off, but that was back when the U.S. interest rate was at 0. Now that the U.S. interest rate is at 2.5%, the Fed funds rate, and it looks like 3 to 3.25 by the September FOMC, those kind of risk-off moves in dollar yen become much less powerful than what we were used to, say, in 2013, 2014. So I think the market is obviously a little bit wary about the Ministry of Finance coming to intervene around 140. But I, for one, think that Japan will stick to its G20 commitments and not intervene. And once the carry flows push dollar yen above 140 and they realize that the Ministry of Finance is not there, then I think that dollar yen should shoot much higher towards 142.
We are discussing China, discussing the RMB and where it's headed at the moment with another stronger than anticipated fixing for the yuan. I believe that this is actually the 7th straight day that they've done this. It doesn't seem to have moved the dial much, has it, Max? What's your take on all this?
Yeah. Well, I will say that today's fix actually surprised me because the model was only basically pointing to a move that was maybe around 21 pips higher than previous, and they still basically adjusted it stronger versus the calculation. So for me, that's a signal that they're basically going to stabilize the fix at 6.9. But I think we've seen recently in recent days, and CNH is still at 691, 692, that the spot rate can actually detach itself from the fix quite strongly. So I think as long as the U.S. data is strong, as long as there's kind of this negative risk sentiment in equity markets, you probably could see some limited upside for dollar CNH. So I actually still like shorting the yuan against the dollar, not in the short term, but I think it's a good position to hold. It's carry positive, and the next time the PBOC surprises the market and cuts rates either in mid-September, mid-October, mid-November, then you'll be already holding that position, and it'll move quite quickly.
Max, I mean, China included, where do you think the market's both underpricing and overpricing a respective tightening or loosening cycle?
I think that in most markets, they're probably not really pricing in enough tightening, because I think if you look at most of the central bank surprises that we've seen in Asia, it's mostly been to the upside, right? The Bank of Korea last week hiked rates 25 basis points as expected, but when they kind of revised their inflation forecast higher by 80 basis points for 2023, the market started pricing in the terminal rate being higher, as it rightly should. Because even though they kind of downgraded GDP forecasts, and they're still raising CPI, and they're basically still signaling that inflation is stickier than they expected. Similarly in Indonesia, they didn't really, or the market didn't really expect any moves last week after BI Governor Warjio said, we're not in a rush. But obviously, the inflation direction is still higher in Indonesia and in India and South Korea, everywhere. So they're going to start moving sooner. And I think that the recent currency volatility that we saw in dollar IDR, in dollar Korea, probably adds a little bit of impetus to be more hawkish as well.
Biggest conviction trade, Max, for you? I know you look at the Thai baht a little bit more. That's also part of the China story, too.
Yes, I do like long dollar Thai baht. It's probably one of my favorite trades right now. I actually opened up this trade 3 weeks ago, and it's actually already at our 36.6 target. But I do think that there is further upside after recent comments yesterday by the Bank of Thailand, which did say we're focused on our own domestic story. The Thai baht exchange rate is just based on a stronger dollar. It doesn't sound like they are too concerned with baht weakness. And when you just look at the fundamentals of Thailand, yes, tourism is rebounding in Thailand, but as long as China remains COVID-0 policy through 2023, at least through the first quarter of next year, that means that 27% of Thailand's usual tourist pool is gone. So they have a lot of excess capacity within the tourism space based on the pre-COVID levels. And one way to encourage that is through baht weakness. So the Bank of Thailand, I think, will keep policy loose, and that will basically push the baht weaker against the dollar.